In the world of trading, technical indicators play a crucial role in helping traders make informed decisions. One such indicator that has stood the test of time is the Moving Average Convergence Divergence, or MACD. The MACD is a versatile tool used to identify changes in momentum, spot potential buy and sell signals, and confirm trends. The MACD indicator comprises three key components: the MACD line, the signal line, and the histogram. The MACD line is the heart of the indicator and represents the difference between two moving averages, typically the 12-period and 26-period exponential moving averages, or EMAs. The signal line, usually a 9-period EMA of the MACD line, acts as a trigger for trading signals. Lastly, the histogram, which oscillates above and below a zero line, provides a visual representation of the convergence and divergence between the MACD line and the signal line. Understanding the interplay between these three components is essential for effectively utilizing the MACD indicator in your trading strategy. While the MACD might seem complex at first glance, its calculation is quite straightforward. The formula involves calculating two exponential moving averages, or EMAs, and then finding their difference. The most common MACD setting uses the 12-period and 26-period EMAs, although traders can adjust these periods to suit their trading style and market conditions. The formula for the MACD line is MACD line equals 12-period EMA minus 26-period EMA. Once the MACD line is calculated, the signal line, typically a 9-period EMA of the MACD line, is plotted alongside it. The formula for the signal line is signal line equals 9-period EMA of MACD line. Finally, the histogram, which illustrates the difference between the MACD line and the signal line, is calculated as follows. Histogram equals MACD line minus signal line. By understanding the underlying formula, traders can gain a deeper appreciation for how the MACD indicator reacts to price movements and generates trading signals. One of the most popular ways to use the MACD indicator is through the MACD crossover strategy. This strategy focuses on the crossovers between the MACD line and the signal line, which can indicate potential buying or selling opportunities. A bullish crossover occurs when the MACD line crosses above the signal line, suggesting that buying pressure is increasing. This crossover is often seen as a potential buy signal, signaling a potential uptrend in the asset's price. Conversely, a bearish crossover occurs when the MACD line crosses below the signal line, indicating that selling pressure is mounting. Traders interpret this crossover as a potential sell signal, anticipating a potential downtrend. It's important to note that MACD crossovers should not be used in isolation. Traders should always consider other technical indicators, chart patterns, and market context before making any trading decisions. While crossovers are a fundamental aspect of MACD trading, there are other strategies that traders can employ to gain further insights from this versatile indicator. Two such strategies involve the zero line and divergences. The zero-line crossover strategy involves observing the MACD line's movement relative to the zero line. When the MACD line crosses above the zero line, it suggests that the shorter-term EMA is greater than the longer-term EMA, indicating increasing bullish momentum. Conversely, when the MACD line crosses below the zero line, it signifies that the shorter-term EMA is lower than the longer-term EMA, implying growing bearish momentum. Another powerful MACD strategy is the divergence strategy, which focuses on identifying discrepancies between the MACD indicator and the price action of the asset. A bullish divergence occurs when the price of the asset makes a lower low, while the MACD histogram forms a higher low. This divergence suggests that selling pressure is weakening, and a potential price reversal to the upside could be imminent. Conversely, a bearish divergence happens when the price makes a higher high, but the MACD histogram forms a lower high. This divergence indicates waning buying pressure and a potential price reversal to the downside. Section 5. Practical example. Interpreting MACD signals. Let's illustrate the practical application of the MACD indicator with an example. Suppose we are analyzing the price chart of a stock and observe the following. The MACD line is above the signal line, indicating bullish momentum. The histogram is positive and increasing, suggesting strengthening bullish momentum. The MACD line is above the zero line, reinforcing the bullish bias. The price chart shows a bullish crossover of the MACD line over the signal line. Based on these observations, a trader might consider entering a long position anticipating a potential uptrend in the stock's price. However, it's crucial to remember that no indicator is perfect, and it's essential to combine MACD signals with other technical and fundamental analysis to make informed trading decisions. Section 6. Pros and cons. Weighing the benefits and drawbacks of MACD. Like any technical indicator, the MACD has its pros and cons. Understanding both sides of the coin is essential for using the indicator effectively. Pros: versatility. The MACD can be used across different time frames and markets, making it a versatile tool for traders. Clear signals. The MACD provides relatively clear buy and sell signals through its crossovers and zero-line movements. Momentum identification. The MACD excels at identifying shifts in momentum, allowing traders to capitalize on potential trend changes. Cons: lagging indicator. The MACD is a lagging indicator, meaning it reacts to past price movements and might not be effective in choppy or sideways markets. False signals. Like any indicator, the MACD can generate false signals, especially in volatile market conditions. Limited predictive power. While the MACD can identify potential trading opportunities, it's not a crystal ball and cannot predict future price movements with certainty. Section 7. MACD versus RSI, comparing two powerful indicators. The MACD and the Relative Strength Index, or RSI, are both popular momentum oscillators used by traders to identify potential buy and sell signals. While they share some similarities, they have distinct characteristics that differentiate their applications. Calculation. The MACD is calculated based on the difference between two moving averages, while the RSI measures the magnitude of recent price changes to evaluate overbought or oversold conditions. Sensitivity. The RSI is generally more sensitive to price changes than the MACD, making it more suitable for identifying short-term trading opportunities. Overbought, oversold levels. The RSI has predefined overbought and oversold levels, typically 70 and 30, while the MACD does not have such fixed levels. Choosing between the MACD and RSI depends on a trader's individual trading style, risk tolerance, and market conditions. Some traders prefer using both indicators in conjunction to confirm signals and improve their trading accuracy. Section 8. Conclusion. Mastering MACD for trading success. Mastering the MACD indicator can be a game-changer for traders seeking to enhance their technical analysis toolkit and improve their trading decisions. By understanding its components, formula, trading strategies, and limitations, traders can effectively incorporate the MACD into their trading plans. Remember that no indicator is foolproof, and the MACD is most effective when combined with other technical indicators, chart patterns, and sound risk management principles. Continuous learning, practice, and adaptation to changing market conditions are crucial for achieving consistent trading success.